Good afternoon, everyone from rainy DC. This is the CLOs, How It Will All Work Out panel. I'm Adam Rissell, Special Counsel at Cadwalader in the Capital Markets Department. I primarily focus my practice on CLOs and other structured products. Along with me today, I've got Mark Boatwright, Eric Glick, and Dan Wohlberg. So I'll pass it to them right now to let each of them introduce themselves. Mark, we'll start with you.
Sure. So Mark Boatwright, I run the CLO business at AIG.
Eric?
Hey everyone, I'm Eric Glick. I head up the CLO structuring department at Barclays.
How you doing? I'm Dan Wohlberg. I'm a director at Eagle Point Credit Management, specialist asset manager focusing primarily on CLO securities.
Great, thanks guys. So as I'm sure everybody could figure out from the title of the panel, we wanted to discuss a pretty relevant and timely topic in the context of CLOs, namely how CLOs are tackling issues related to workout and restructurings of the underlying loans. This was a topic that kind of came to the forefront beginning middle to late last year, but because of COVID became even more important in the context of CLOs. There was obviously some stresses in the loan market at the end of last year, and then once the COVID lockdowns hit, there was a great expectation that there was going to be a lot of headwinds in the loan market and a lot of defaults and distressed situations that would lead to a lot of workouts and bankruptcies. There was deteriorating credit quality, loss of revenues, a lot of stresses on those underlying loans. However, it turns out it wasn't as drastic as was expected back in March. Nonetheless, the CLO market still does face headwinds in the loan market and the underlying loans that they're investing in. So there are still going to be a lot of stresses in the workout and restructuring of those loans. What we want to talk about a little bit today is how CLOs are addressing that. As I'm sure most of you know, CLOs aren't necessarily constructed to do mass workouts. They're more meant to buy and hold and trade assets, but not necessarily be intimately involved in the workouts and restructurings of those assets. So what we want to talk about a little bit is how that's being addressed in the context of CLOs. Also, Volcker limitations related to CLOs. We'll touch on this in more detail later in the panel, but prior to the Volcker amendments coming into effect, CLOs primarily relied on the loan securitization exclusion, which very much limited their ability to participate in workout and restructuring scenarios. The scenario in which this really came to a head was at the end of 2019 in the Acosta bankruptcy, among others, but Acosta is the most well-known. In the Acosta bankruptcy, distressed investors, namely hedge funds, bought up a majority of the debt so that they could control the bankruptcy process. While the CLOs had numerosity, i.e. they had the most holders of the debt, the distressed hedge funds had the largest amounts. And so the distressed hedge funds were able to structure the bankruptcy exit for Acosta in a way that was detrimental to the interests of the CLO holders. In Acosta, what happened was the debt investors were offered common equity in exchange for their debt, as well as new issue preferred equity. The issue with the new issue preferred equity is that it required an infusion of new capital from the debt investors, which CLOs at the time were generally not able to participate in. And further, the structuring of the bankruptcy concentrated much of the value of the restructuring in the preferred equity rather than the common equity. As a result, the recovery that CLOs got in respect of their debt in Acosta was much less than the recovery that they could have gotten had they been able to participate in the PIK preferred equity, which also was a prerequisite for participating in the DIP financing, another source of value that CLOs weren't able to realize. As a result, in addition to the lower recovery rate, CLOs also generally became forced sellers of the assets they received in the bankruptcy. Ultimately, what it turned out to look like is that this has become the playbook for distressed debt investors as to how to approach workout and restructuring scenarios to the detriment of CLO vehicles. And so as a result, the CLO market has been exploring new ways to retain value in these workout and restructuring scenarios. And so to dive into that, I'll turn first to Mark as the CLO manager on the panel. Mark, in Acosta type scenarios or other workouts and restructurings, how do you typically see this play out in the CLO context? And what are some of the challenges that collateral managers such as yourself face in those workouts and restructuring?
Sure. Well, the first thing I observe is that this isn't really anything new. The prior crisis back in 08, 09 saw similar scenarios. And so it's not so much a new development as it is just something that, as you see more stress in the loan market, you're going to see more restructurings, and they're going to see, typically the typical players or investors that invest in restructurings, i.e. hedge funds, opportunistic distressed debt investors, come in and really try to structure things in a way that's more favorable to them, and that don't really work for CLOs, or frankly work for banks or other regulated financial institutions that also typically hold debt. I think the difference really relative to the prior crisis is, there definitely were some stress situations. There definitely were situations where there were dilutive kind of restructurings that CLOs couldn't participate in. But I think with the amount of debt that's now outstanding and how much the CLO market has grown, and then the much greater number of CLO managers and players, and then the stress that we're currently seeing, certainly this is topical. I think typically, if you kind of look back to the prior crisis, it was more severe, it was more protracted. So it gave CLOs the opportunity to reinvest in loans at a substantial discount and then participate in that kind of natural pull to par. There were obviously bankruptcies back then, there were restructurings, but I think they kind of got lost a little bit in the crush because there were other opportunities for CLOs to play in. Also back then, they're just different structures to the loans. Recovery rates, kind of were typically higher. And so it paid to hold and not sell out. That's what, in my prior, where I served in a prior firm, that's what we did. And our deals really benefited from that kind of hold strategy and kind of participating and trying to restructure things through committees. I think the trend really in the last few years has been sell fast. And so certainly that's what we saw in Acosta. It was kind of seen as, okay, this could be a black hole. A lot of guys were moving paper out quickly. There were others obviously that were trying to hang in and hold on. But then as details emerged on who the new holders were, even more fear, set in. And so you had this loan, which was kind of hovering in kind of the low 70s, high 60s, where like a lot of that paper transacted initially. When it became evident that this was going into restructuring, but not on very favorable terms, the loan just went down into the 30s and 20s. And so this is the shock value for loans, right? Because they're supposed to recover 80 or maybe 75. And now when you see a loan trading, in the 20s and 30s, people say, hey, what happened? All right. So, I think the defense mechanism going forward, we'll get into this, I know later on, is that we've got to come up with other tools to make CLOs better holders. So they're not kind of, just fear factor sellers. Because I think the natural inclination for CLO managers and CLOs is to hold, because the recovery on first lien senior secured debt should be high, should be much higher than unsecured bonds. But obviously in this case, where you have players coming in with really aggressive terms, restructuring terms that can effectively use those structures to wipe out senior secured lenders, it just creates enormous fear. And so people are very fast on the sell trigger, and trading desks know that. And so they move their marks down, really rapidly. So that's kind of a summary of the dynamic.
So Dan, given everything that Mark just mentioned about the challenges and the detriments to challenges that CLO managers face, as a big equity investor in CLOs, what's the impact that you've seen as a result of these challenges in Acosta-like situations?
Yeah, I mean, first of all, I mean, what a great summary by Mark there of kind of all of the sides of the ways that it influences the way managers manage their portfolios. And ultimately, the magic behind CLOs isn't all that, as confusing as these things all can be. It really is having, non-mark-to-market leverage on what is the highest in a large company's capital structure loans that are underwritten by smart people like Mark. And, a lot of these assumptions bleed into, recoveries, because we all do assume that certain companies won't work out and there will be certain issues. And I mean, look, historically, there have been defaults where the recoveries have been greater than par, right? I mean, it's really about having managers that can effectively manage the portfolio of par loans, but also, be able to make decisions along with these companies to the end of these loans that they've been underwriting. And what's developed in our market, Mark, kind of hit the nail on the head about, is when you have this somewhat interclass warfare where you can't count on the fact that you're senior secured anymore, and you combine that with the fact that CLOs are majority of the broadly syndicated market, these two things should mean that CLOs should be a little bit more in the driver's seat of these restructurings. In the old time, they could tag along, it wasn't as big of a deal. Now they can really be drivers. And then finally, it is, managers are smart. They're going to do the best they can to help these companies in ways that are accretive to their portfolios. And you want those recoveries to be in the CLOs, not somewhere else in the manager's house, to be able to make those investments. So you put that all together, and what you end up with is a little bit of a hole in your investment thesis as a CLO investor, because now you have to make sure that in distress, a little differently, your CLOs have a way to not be forced to sell early. Hearing as an investor that a manager's best option is to sell early is not great, unless they have a view that the credit's going down, not because of some market dynamic. That's not what you want to hear. So I think what we've seen through COVID is very much, whether you're an equity investor or, we're a materially large debt investor today too, is a concerted effort by CLO investors to say, well, this is not different. This is a manager holding the same loan I've had them underwrite. How do I make sure there's a balanced way that not solely due to, document or contractual terms that are not harmful to me, am I forced into a loss that's not necessary, especially when the difference in recoveries can be 20, 30 or more points.
I think that's a great point, Dan. And you mentioned those tools that CLOs would look to avail themselves and kind of come up with. And so, Eric, I'll kick it to you as the structurer of the group here. Now, what are you seeing across the market, these new tools, and what are the tensions in putting these into documents?
Yeah, thanks, Adam. Yeah, I mean, I agree with Dan. I think CLOs should be in the driver's seat. They have the purchasing power to do that, but the problem is that historically docs, have not allowed for it. So I think the CLO market has recognized that after the Acosta situation and others like it, we started to make some changes to docs that allow for CLOs to participate in these situations more easily. I think there are three main things that matter the most to managers and investors. Number one is going to be probably the one that most people are focused on, which is under what circumstances you're actually allowed to put money into a workout. Historically, there have been some provisions in the doc that prevent you from putting money into workout situations, and that's what some of these distressed investors have been able to use to their advantage. I think also maybe equally important, though, that, or at least a major focus will be once that asset is received, how it's treated for the OC test purposes of the CLO. And then lastly, something that Dan will probably be focused on, but equity investors in general are focused on, is under what circumstances the money can be released. So like I said, I think the biggest question, the one that most people are focused on, are what circumstances under which the CLO is allowed to put money into a workout situation. This has started to loosen up over time, but originally we saw that only interest proceeds that were left over after paying the waterfall or newly contributed principal could be used to go into these types of situations. But more and more, we're seeing the docs allow for principal to be used. As long as there are certain hurdles met. I think some of those hurdles that are negotiable in docs will be whether or not under how much par the CLO has to have before you're allowed to use principal. So some docs require the amount of par to be above the initial target par, but now we're actually seeing more and more that you can have some loss. Usually it's somewhere around $2.5 to $5 million of losses and can still use principal. There are also negotiated whether or not you can have an annual or a cumulative limit. So that's definitely negotiated a lot on deals. And there are also some differences in what the manager is allowed to do if it's a loan they're receiving versus if it's an equity security that they're receiving, which we can get into more detail when we talk about Volcker, but that is also an important distinction. So then the next question is how the asset would be treated for OC test purposes once it's received. When these provisions first started making their way into docs, investors wanted everything to be treated as zero, obviously. But that really impacts managers' incentives because they're not going to be incentivized to put money into a situation where they'll receive zero par credit. It's just going to hurt them from an OC test perspective, and that's really important to managers. So even if it might make sense from a recovery perspective, it can sometimes be the incentives of receiving zero par credit would make them not want to invest in that situation. But again, as the market's gotten more comfortable, we've seen the docs allow for loans specifically to be treated as if they were just defaulted, even if they're not, meaning they get treated at the lower recovery value and market value, whereas equity securities are still treated at zero. But still, that's a major distinction for managers because they can get credit at least. And I think the last question for CLO equity investors in particular will be the circumstances under which the issuer can release proceeds. Again, this is highly negotiated point. Also, the rating agencies have put their foot in this as well. But the way this seems to be migrating is that you can release proceeds once you've reached your carrying value. And even though some investors do say that they will negotiate that you can only release proceeds if it's been interest or contributions that were used to buy the assets. So again, it's a negotiated point. I guess overall, the point is that I think the market is moving towards making this process of getting involved in workout situations easier. I personally expect that over the next few months, a market standard of some sort will likely be reached.
And so, Eric, do you see most of the pushback coming from investors or rating agencies, or are they focused on different things?
I think the rating agencies generally just have kind of like their minimum standards that they look for, and so they're less negotiable for the most part. I mean, occasionally you can get them to move a little bit, but if it's in their policies, they're not gonna change it. Beyond that, then there's more negotiation of what can we do beyond what the rating agencies simply require. And investors are very focused on this. Like I look at some of the deals that we have gotten stips on, and we've had somewhere where multiple investors have had multiple stips on this. And it's definitely, I think, a very topical point for CLOs right now. And that's where we're going to start to coalesce towards some sort of market standard, hopefully, and then it won't be as negotiated from a deal-to-deal basis. But whenever these things start getting implemented into docs, they start very, very tight, and then over time, the bigger managers can start to throw their weight around a little bit and get more and more into the docs. And eventually, I think we'll probably get to at least a general market standard.
And so that, Dan, you obviously touched on the decline or the detriment in value of the restrictions that many CLOs previously faced. How did you see the value in these tools that Eric talked about? And you're obviously an equity investor. What's the value to debt investors as well? Like, why is it important that both for the debt and the equity that these tools are available to CLO managers?
Well, I mean, the investment's going to get made, right? I mean, it's somebody is going to put that money in Maybe it's in the CLO, maybe it's not. It could be the manager using an unconstrained vehicle the same way. Either that or your manager is going to sell an asset at a par loss that maybe you don't need to be taking if the manager could just hold it for, let's say a couple months more. Very often, there could be liquidity in the asset later, or the payoff could be helpful. I really don't. I mean, Eric, hit the nail on the head with a lot of the intricacies, and it's an incredibly nuanced issue. But I don't think any investor is adamantly opposed to the concept. I mean, even before we got here, right? I mean, there's been slight allowances in documents before for warrants and things like that. I think in general, our market has had somewhat of an understanding of a small allowance of these sort of things in certain instances. It's just more pronounced now when you have these concrete examples. And on top of it, you have examples where managers have done exactly the opposite, right? Where you see a very, very CLO friendly capital structure come out of restructuring because the in crowd happened to be a bunch of CLOs. So, you start, when you put those things together, it becomes much more of a focus for the market. The only thing I would disagree with Eric on at all would be the importance. I don't think you meant it, but the importance of the rating agency, I don't think can be overstated. As investors, I can negotiate, through Eric, all day with a syndication of banks and insurance companies, guys who trade loans all the time, who really understand the ins and outs, and we can discuss upside. And as an equity investor, I can say, oh, we'll split proceeds this way, and it can become a very economic discussion. The rating agencies are not economic in the way that they're thinking about it, and very often their criteria is quite rigid to start with in some areas that make it difficult. One of the things Eric touched on is like the use of principal proceeds. It's actually very difficult to get that through rating agencies who are very worried about par leakage, right? Even if you can point out to them that the recovery increase substantially outweighs, a couple points of collateral par value, their systems are very much hardwired. So, whenever the market comes into these situations, it's a very thoughtful market. CLOs, it's very much a collective conversation on a multiple deal basis as these provisions grow up, whether it's this, or you could go back to even when Volcker was implemented, or LIBOR language, or risk retention language. All of it tends to go a very similar way, whereas sponsors, equity investors, and managers who are looking for ways to attack the new market are functionally working alongside, their lenders, their security buyers, and the guys who are giving them the ratings to kind of fit through two hoops that are not always overlapping. So, what's been a focus of ours is making sure that the provisions that are added to documents are useful, because we can put in marketing pieces all we want about, well, we can invest in these and they'll rescue loans. But if you tell me as an equity investor that I'm going to put money into a distressed situation and then I'm not going to see it for 6 years, and maybe not even get it paid if the OC test fails, I may call the manager and say, let's make the investment unconstrained, right? I mean, so I think that the debt community, as much as the equity community, understands this has to be balanced such that it's incentivized for us to use these tools. But at the same time, even equity investors don't want to give managers, full reign to do all of the distressed situations they can. None of us got into this to buy distressed assets. We can certainly go do that anywhere. There's a lot of guys raising money in distressed over the last year or so, right? I mean, we can certainly do that. This is about being able to see these things through to the end and giving guys tools to be able to play defense and, sometimes a little bit of offense where it makes sense.
Great. I think it's really interesting how you said, even as the equity investor, these tools are limited, and you're not giving the managers free reign necessarily. And so, Mark, I'd be kind of interested in hearing your view as the resident manager here, how you see these tools being used, or if you even have, or if there's a scenario where you had kind of tangible result that wasn't as good as it could have been had you had these tools at your disposal.
Yeah, definitely. So, I mean, I actually, yeah, just following on Dan's line, I totally agree with respect to the rating agencies. I think actually part of that, however, is really more sort of legacy, because the way CLOs originated really were to have banks take loans and pull them off balance sheet into bankruptcy remote vehicles. So those were balance sheet CLOs. And then ultimately, because the structures worked so well, it became a structure that was really effective for third-party investors for cash flow CLOs. And so you have the documentation, and that's really kind of a legacy documentation that's been around for a very long time. And while on the one hand, that's good because it's proven to work, the technology really does work through periods of volatility and actually quite well for investors. When you try to change the documentation, change these structures to add these features because of new developments in the market, you get some resistance, and the resistance, I think, largely is because people just don't want change, right? And justifiably so. If something's worked in the past, why change it? So you kind of have this educational component of what you have to do, and I agree with Dan that I mean, we find our investors are quite reasonable. In fact, they like these types of discussions to sort of have dialogue and see, okay, what's going on? Are there things that are going on in the market that could present challenges for CLOs? They're very interested in this type of a conversation, but I think it needs to kind of get the follow through so that we, again, can kind of come up with reasonable standards that are generally accepted in the market, so that we have greater flexibility or less constraints to do what we think best to maximize recoveries. And again, this isn't like every day, right? Because most loans actually don't default, thankfully. And many of them, if they do look like they need to restructure, often there are ways that gets done that's quite favorable for the debt. But in those instances, like Acosta, we really do need greater flexibility so that you can take what essentially, obviously it was debt in the first place. If it gets restructured as debt, that would be fine. If it gets restructured as equity, suddenly it's the same. Effectively, you're in the same position. We're just calling it a different thing. It's a different form. And suddenly that's when A, the structure doesn't allow it. B, investors, including rating agencies, start to freak out because that's not what that's not the world they're comfortable with, right? Especially the agencies, because they have tons and tons of data about how loans have performed in the past, and that's how they get those ratings with leverage and other factors. And so now when you suddenly change it, the asset to something that's not debt at all, it doesn't really compute within their systems. So we have to come up with better, kind of features to the indenture methodologies and get buy-in from the agencies as well as from investors of all classes.
Great. Thanks, Mark. And I think your point about the limitations that they face documentation-wise is a good segue to kind of our next discussion topic, which is the recent Volcker changes, which actually just went into effect on October 1st, so not too long ago. I'll give a quick overview of what those are for everybody. But as I mentioned, October 1st, the Fed and other government agencies responsible for Volcker announced changes earlier this summer that went into effect on October 1st. Among other things, the two probably most pertinent parts of that as it relates to CLO is that the loan securitization exclusion now permits a 5% bucket for non-loan debt securities. And it also changed the ownership interest analysis as it relates to CLOs. Historically, CLOs had relied on the loan securitization exclusion, which Dan kind of touched on a little bit. But what that meant is that CLOs could only buy loan assets. They couldn't use new money to acquire equity securities or to exercise options or warrants. Dan had alluded to that limited ability to exercise warrants in the past, but that was only in scenarios where those assets would be considered received in what's called in lieu of debts previously contracted. So effectively an exchange, but CLOs, as a result of this reliance on the loan securitization exclusion, weren't allowed to use new money to purchase non-loan assets. Under the LSC, there's now a small 5% bucket that permits that. One thing I will note is, however, that it's unlike what was originally proposed in the Volcker Amendment proposal. The loan security entities relying on the loan securitization exclusion can't buy non-debt securities. So they can't buy equity securities outright. They can only buy bonds, notes, or loans. And the bonds and notes count against that 5% bucket. So what we're seeing a lot in the market is most CLOs and CLO managers are moving to the analysis under the Volcker rule that senior debt instruments don't constitute an ownership interest in a covered fund. And why that matters is because historically under the Volcker rule, until the amendments went into effect, the right to remove and replace the collateral manager was considered a hallmark of an ownership interest. So there was always a question of whether AAA notes constituted an ownership interest, which was problematic for bank investors. In the Volcker amendments, they actually explicitly stated that the ability to remove and replace a manager for cause, generally speaking, what everybody's familiar with as cause in the CLO market, would no longer make a debt instrument an ownership interest. So that, for AAA notes, it's very clear cut that they are no longer considered an ownership interest in a covered fund. It's an open question as to whether that would apply to all of the rated notes in the capital stack. I won't necessarily opine on that on this panel, but I think there's a view in the market that it should, that same analysis that applies to the AAA notes should apply to the entire rated note stack. So once you're relying on the no ownership interest analysis, that does in theory mean that you could have 100% non-loan assets. Obviously, CLOs that's not the market for CLOs, so there will still be contractual limitations around that. But the big change as it relates to CLOs is that it gives them a lot more flexibility in workout restructuring scenarios, as it gives them some flexibility in what they can buy and what they can use proceeds for, which I know our panelists will touch on a little bit more. The one thing that I will note before kicking it to my colleagues here is that the Congressional Review Act does permit Congress to effectively rescind a rulemaking, or in this case, the amendment to the Volcker rule, within 60 session days. So not necessarily 60 days, but 60 session days from the day that it went into effect. Given COVID and kind of a weird year, not to mention a weird election year, it's unlikely that Congress will actually have 60 session days before the new Congress sits, at which time that restarts. So understanding that the composition of the Senate is still up in the air, there is a small risk that under the Congressional Review Act, the Volcker amendments get repealed. As when we're having discussions about this, as Dan mentioned, it's not necessarily going to be because there's a focus on these two particular items in respect to CLOs. The Volcker amendments are much broader, so there would be focus elsewhere, but the result would be effectively that CLOs are the baby that gets thrown out with the bathwater. So just something to keep in mind, as there are certain instances where investors have asked for conditionality around the ability to acquire non-loan assets. So with that said, and Eric, you kind of alluded to this earlier, I'll kick it to you to kind of discuss how the market has generally responded to these Volcker changes and what you're seeing in CLO documentation as a result.
Sure. Yeah, thank you. That was a very good overview. So, I mean, I guess there's 2 points here. The one is just in general how people are dealing with bond buckets and how they're putting them in. I think, as always, there's many different flavors of this, and it's negotiated point. But when these first came out, I think what we were seeing, again, the very first flavor of this was to allow for a 5% bucket which allows you to be within the loan-only securitization exclusion, and also senior secured only. That made investors a little bit more comfortable. Over time, we're now seeing that 5% increase to allow for unsecured bonds as well. And we've even actually seen a couple versions of this that have gone to 10%. Obviously, if you go to 10%, that takes you out of the loan-only securitization exclusion, and then you have to rely on the fact that it's no longer an ownership interest for senior debt, as Adam mentioned earlier. But I think investors are getting more and more comfortable with that fact and not relying on the loan-only securitization exclusion. So I wouldn't be surprised if you saw more and more deals that have more than 5%. I should mention one other point that's kind of important here is that the bond bucket is a subset of the non-senior secured loan bucket, which is the same bucket that is more generally usually used for second liens. So what that means is that if you want to use the bond bucket, by definition, you're lowering your ability to buy second liens. So that is an important distinction, I think. But this also brings up another point. I mean, I think what some of these distressed investors were kind of using to get a leg up was the fact that CLOs weren't allowed to invest in situations in which they would be receiving equity in exchange. And part of that was investor driven, but also very importantly, Volcker was a large part of that because as Adam mentioned, you could only receive equity in lieu of debts previously contracted. And so what that meant was you couldn't put money in if you were receiving, or at least you couldn't put principal in if you were receiving equity in return. And so now that Volcker allows, for you to rely on the fact that it's not an ownership interest, and therefore you theoretically could put money in not in lieu of debts previously contracted, that's a major change that allows for CLOs to now explicitly put in principal and receive equity securities back. And that's going to, I think, prevent some of these Acosta-like situations as these start getting added into docs. I should mention that it's going to take time, right? Because most docs are not going to allow for you to amend the indentures to allow for this right away. So it's not like the wholesale CLO market tomorrow is going to be able to do this. It's going to take time for some docs. Maybe they'll be able to amend them. And then some deals will be reset and refied. But really, this is just going to be a situation of as more and more deals get done with this type of language in it, you'll see the CLO market have more flexibility and potentially prevent Acosta-like situations from happening. So that's kind of how I see things going in the future.
Great. And Mark, Eric touched on a couple key features that we're seeing in CLOs as a result of Volcker, namely the bond bucket and the ability to acquire equity securities. How have you been implementing those in your deals, and how do you see utilizing them going forward?
Yeah, so obviously there's a positive development, but as Eric said, it's going to take time. And so, we've been at this for a while, like trying to integrate more terms in the docs that will allow us that flexibility. So this obviously gives us encouragement. It kind of opens up the opportunity to do more of that. I think more fundamentally, it's that it becomes more accepted within the broader investor community. Obviously, we've got to get more data points from the rating agencies and kind of understand, their methodologies, how they're going to, adapt their methodologies to incorporate for greater flexibility in the docs. But I think it's also important to kind of to emphasize that there's still a long way to go, I think, because you can put up, every development kind of creates a new set of rules or a rule book. And then look, hedge fund guys are super smart, right? And so they just look at that rule book and they say, okay, the last time we did it this way. Now that won't work. So let's figure out another way and try to punch holes in it. And so I think it's really, we really are going to have to open up, I think baskets where, and whether this takes the form of sidecar arrangements or whether it's a basket directly in the deal, to allow new money from the CLO to go into really pretty much an unconstrained, whatever form it takes to preserve value in the face of investors who are essentially using structures to try to extract value from the fund investors.
Yeah. And Dan, interested in your thoughts, what you view as the most accretive to equity of those tools. You mentioned earlier that some limits on manager flexibility. So, interested in your thoughts.
Sure. Yeah. I mean, this one is always one that's to me, I don't want to say personal, but certainly a little bit personal. The application of the Volcker rule to CLOs, if you remember, Congress was trying to prevent banks from owning equity in hedge funds. That was the goal. And what that turned into in our market was because banks buy AAA rated debt instruments in packages of senior secured loans and 5 to 10% of non-loan assets, suddenly our whole market had to rip bonds out, on April 1st, I think it was 2014. I think we were all working at different places then, but we all probably spoke that night or over the next couple of days about deals in process and trying to figure it out, because even back then, we didn't think we were going to get included. We thought there was a bunch of different pushes, which now are codified, right? The amendment basically took the arguments that, people like, us, the four of us here have been making for the prior 4 or 5 years to finally be in the deals. So I think it's a welcome relief to the market to finally have this back. And, my co-panelists pointed out the two reasons perfectly. One is being able to buy a little bit of bonds at the expense of second liens is good, because the point of the non-senior secured loan basket is to give a little bit of flexibility to the manager to build par, build spread, and do things around the edges. And obviously it's much easier to build par in a bond, which, Mark can trade up to 130, than a second lien loan, which is functionally interest proceeds, which is great for equity, but it doesn't really help debt investors that much. So it's a good thing. To the other side of it, which is all these unintended consequences around distressed investing, because guys could literally use this policy against CLOs in some ways. It's hard for me to say which is more important. Certainly in a market like today, the distressed one is terrific. But you talk about restraints. It's not as much that I'm in favor of more restraints on managers. I'm generally in favor of we do the diligence on the managers. We believe in them. We pick the ones that we want to give more flexibility to. But it's more of just a general understanding that these things are not necessarily bad just because they're different. Mark made the point about change before. The same applies here in the inclusion of bonds. In a Cov-Lite world, you'd probably rather own a senior secured bond than some second liens. It's kind of a question nowadays of what's the point, right? Why do we have this restriction? It was purely unintended. And now hopefully we won't have a situation where just solely due to wanting to make other changes, we get caught up again, because in both respects, it's not a huge change to the whole portfolio. It's a couple of positions, but on the margin, it's going to be important, especially when you talk about managers' abilities to play defense against, whether it's in distressed or whether it's using their bond basket to build par or to make simple, Mark may look at a capital structure with a loan and a bond that are priced differently with similar risks. Being able to play between those two in the same issuer, just that alone is a par building activity that really doesn't increase risk. So just allowing these guys to do this again is going to be important towards everybody's outcomes, because they're you can't buy CLO single A's anymore due to rating agency criteria. So the way that managers can build back par and can make these investments are through a lot of these pathways. So it's just, in my mind, it's good to erase the last 6 years, go back to normal. You point out, hey, maybe we can put more in because, BBs aren't really an ownership interest, or, pickable versus non-pickable. I know we can all argue that stuff, But in general, the market's not going to go to 25% bonds and CLOs. We have CBOs, we have CDOs, we have other products. This is allowing CLOs to have a normal fringe ability to see investments to the end, and also to make plays in capital structures. The experts you're hiring to do can do in a lot of times with very little added risk.
I think that's a great summary, Dan. Kind of the usefulness of all these. And as I'm getting warned on time here, I'll ask a quick question of everybody, and we can keep it short. Just as one of you mentioned earlier, CLOs make up a big proportion of the loan market. Anywhere from 60 to 70% of any particular loan. How do we move forward in a cooperative manner to serve everybody's interest, rating agencies, debt investors, equity, but still give this flexibility that Dan just touched on? So Eric, I'll start with you.
I can do it. Sure, I'll give it. I mean, my view is it's just getting the word out as much as possible that this benefits everyone, right? I know Barclays has put out some research on it. We're doing panels like this. More and more deals are getting done where investors bring up the question, and instead of just pushing back, it's giving an explanation. Why does this make sense for you? We're not trying to do something that's just good for the equity, right? This is something that makes sense for everyone. Senior secured bonds, as Dan mentioned, are probably, safer in some respects than second lien loans. Being able to invest in distress situations where you potentially just get a worse recovery if you can't, that's not good for anyone. So I think it's just getting that word out so that everyone understands it's better for everyone to have that type of flexibility. Trust the managers you're investing with to do what's right for you. And I think over time people are going to learn that, and it's already starting to migrate that way.
Mark or Dan?
Yeah, I would agree. I mean, that was the comment I was going to make. Actually, it's just that a lot of these things really are not. It's not equity friendly, right? It's not favoring the equity versus the debt. There's no kind of lose win. It's a win-win. And frankly, it's a win not just for the individual investors, but for our entire market and our entire product. So I agree with Eric. You've got to get that word out and get buy-in across the capital stack, as well as all the constituents, including the rating agencies.
Yeah, I mean, I agree with everything that they said. I mean, obviously, what we've grown as a market so large at this point, there's a lot of different options. I mean, there are a ton of CLO managers that have terrific high yield bond performance. So, Eric makes that great point. It's about conversations, having them across investors, and managers being able to say, look, here's my high yield bond performance. This is why you should give me an opportunity, or these are examples of trades I might make, and actually taking the time to converse about it, because our market is mostly afraid of things it doesn't understand. You don't want something slipped in that you don't know what it is, how it's going to bite you. Generally, I mean, Mark made a point earlier, I'll say most investors are reasonable. I'd love to say all. Most investors are reasonable. So, if you have a conversation, guys are going to at least give you some allowance. And then this is not something that's going to happen overnight. Like Eric said, most deals can't change. You can build performance as a manager, and over time, maybe these things grow. But I think what's useful in our market today is just keeping the conversations open and going, on and on and on, because it is, as Eric pointed out, it trends towards a good outcome. It takes some time.
Yeah. Thanks, guys. I think those were great points. We have a few minutes for questions and answers. I don't know if we have any questions teed up yet for our panelists. I don't. Yeah. All right. Looks like no questions. So thanks, Dan, Eric, and Mark, for your time. I think and hope that this was a timely and informative panel for everybody. It's an important area of focus for the CLO market, and one that we hope to see kind of progress for the benefit of everybody in the market.